There we go. Okay, I'll draw your attention to our disclaimer, which you can read at your leisure. Just the highlights of the business in terms of who we are. We're the owner of the Blanket Gold Mine in Zimbabwe. It is, in terms of the scale of the assets, about a 56,000 ounce production last year. We produced at an all-in cost of just below $850 an ounce. We're guiding 55 to 59,000 ounces this year at costs roughly similar, and we're investing fairly heavily in the mine to grow production to 80,000 ounces by the year 2021. This is a mine that we acquired from Kinross in 2006. It's been a great investment for the business. We've owned it through all of the difficult times in Zimbabwe, through the hyperinflation, through all of the tough political environment, and with the transition of leadership last year, it's great to be operating in a jurisdiction where we have the confluence of being close to the end stage of our project, where the investment is about to bear fruit, and for the environment to be improving quite dramatically in the country as well. So it's great to be in a jurisdiction that's improving dramatically in Africa. We're pretty well cashed up. We have $13.4 million in the bank, and we pay a dividend, which is slightly unusual for a junior of our size. The dividend yields about 3%, and we're quite proud of that. It's certainly a key strategy in terms of our investor returning cash to our investors. This is our capital structure. You can view it at your leisure, but the reason we benchmark ourselves there to the GDXJ, which is in the top left-hand corner. We've had a pretty good run. Most of that performance, or a lot of that outperformance, has been the dividend. You know, the yield used to be much, much higher. The stock used to be yielding as high as 10% several years ago, and the share price has run, and the dividend acts as a very important ballast for that. So like I say, we certainly think it's a key part of our investor strategy going forward. These are our operating results. So we're building quite a decent track record. That's 15, 16, and 17. The number I draw your attention to, in the interest of time, we don't have time to go through all of it, but the operating cash flow, about halfway down the page there, this business generated $24.5 million of operating cash last year in 2017. For a business with a market cap of $90 million, we think that's a pretty healthy number. I did mention we're investing fairly heavily, so a lot of that money is going back into the ground. You'll notice the line just below that capital investment was $21.5 million. So we generated $24.5 after tax. We invested $21.5, and the dividend cost us about $3. We have about 2 more years, or 18 months to go of heavy capital investment, and after that time we'll be at the happy confluence of a capital project that's coming to account. So the capital investment will tail off, the operating cash flow will rise quite substantially, and we'll have a decent wave of free cash flow coming through from the asset. As I said, we're in Zimbabwe. This is a substantial gold producing region. I don't think it's overselling it to say that this is probably one of the last gold frontiers in Africa. This is a region that used to be the third biggest gold producer in the continent, behind Ghana and South Africa, and unfortunately due to difficult economic policies, that investment that didn't receive the investment that other countries received, but it used to be bigger than Tanzania, bigger than Mali, bigger than Burkina, Ivory Coast, and all of these places. The gold is still in the ground, and we have a good, we're well placed in terms of competitive advantage to go after this. Just that greenstone region there, the sort of northeast to southwest trend, is about the size of Burkina Faso. So this is a big place. There's plenty of gold in the ground, and we feel well placed to go after that. We're down the southern tip of the country, the Gwanda Greenstone Belt, so that bottom region down there. Those of you who follow the politics, I'll just draw your attention to, if you want to form your own opinion on the country and how the politics is changing, the new president who was sworn in last year in November wrote an article in the New York Times about 2 months ago now. So you'd obviously have to take him at his word, but read the article. Just Google Emerson Mnangagwa New York Times, and you can see what he wrote and just get a feel for what the type of investment climate they are trying to create and what their strategy is going forward. It certainly has been a difficult environment to operate in, and we see things improving quite dramatically, and you obviously have to form your own view, but that's a data point to look at. So there's probably 2 concrete policy issues I would point to in Zimbabwe. The first one is the fact that they've recently introduced an export credit incentive of 10% of revenue. So we get paid 10% of revenue over and above the spot price of gold at production in the country. This probably makes Zimbabwe, if you take the tax rate of 25%, a royalty rate of 5%, and then an export credit incentive of 10%, which effectively means a sort of negative 5% royalty, we think that puts it as the best fiscal terms in the country, in Africa and possibly even the world. So certainly doing things to encourage investment. They've recently completely scrapped and unwound their indigenization and local ownership requirements. Previously in the structure I put in here, we own 49% of the asset and local Zimbabweans own 51% of the asset. That law was cancelled in February, and we're now in a process of unwinding that structure by buying back some of our local partners, and that's a live issue we've communicated already. We hope to be concluding that probably sometime this year, but certainly an exciting time to be increasing our stake, hopefully to about 80% of the asset. These are our resources. We've got 1.6 million ounces. The important thing is the trend. We've grown this resource base every year for the last 6 years. And 1.6 million ounces even at a production rate of 80,000 ounces is a pretty healthy life of mine. Currently goes out to 2031, but the mine's 112 years old and certainly never had a 112-year mine life. As I said, we are investing very heavily. We spent $21 million last year. We've got another $21 million to spend this year and next year, and that is in building a new shaft underneath the current operation. So that's a cross-section of the asset. It is about 3 kilometers north to south. That's a vertical section through the ground. That's about 750-meter constraint. That's the green there is the infrastructure we bought from Kinross. As I said, this was in good shape when we bought it, but that's given us about 12 years of life, so it's done its job. But these vertical mines, you've got to keep going deeper to follow the ore. The colored sections below there are the indicated and inferred resources and some measured resources at depth below 750 meters. Currently, our men have to come down that shaft on the far right, walk all the way along the bottom. The ore's got to be trammed back. It's not an efficient way to run an operation. We are investing at the moment in a new shaft which takes us from surface all the way down to 1.3 kilometers. It's one of the biggest gold mining projects in Zimbabwe. It opens up 4 operating levels below us. Each level gives you 5 years of life. So this will set us up for the next 20 years, resource dependent, at a production rate of about 80,000 ounces. Obviously, we have to explore to find additional ounces, but there's plenty more. We haven't drilled the bottom of any of these deposits. And I say the mine is 112 years old. As long as you keep investing, you generally keep finding gold at depth. Those are just a few photographs of one of the first horizontal levels. And as I said, production, this will take us from about 56,000 ounces last year to 80,000 ounces by 2021. And that will get our operating cost down to about $750 an ounce. So we believe certainly a comfortable operating margin. And this is probably the most important slide of my whole presentation, if you remember nothing else. This is straight out of our cash flow statement. So 2015, 16, and 17 are actual numbers. As I mentioned, last year we generated $24.5 million. We invested $21.5 million, and the dividend cost us $3 million. So we kept the dividend roughly flat. It was covered by cash flow. The investment that you're seeing here is completely covered by cash flow. We have 2 more years of heavy capex to go. And after that, 2020, we commission the project. 2021, we ramp up production. And we have the happy confluence of events where the project is brought to account, capex starts tailing off, and we have this wave of free cash flow that's going forward. And this is where the maths gets easy, right? You've got 80,000 ounces, all-in cost of $750. That's an operating margin of $550 an ounce. That's $45 million of EBITDA. After taxes and minority interest, remember I said we have a minority shareholding in the asset. Sorry, we have a minority shareholding in terms of our local partners. That gets us to about $25 million of free cash flow a year. So that's out to 2031. We certainly think there's more gold down there at depth, but that for a business capped at $90 million, we think that gives a pretty compelling investment proposition. Very briefly, we are exploring around the mine, which if we do find additional, there's artisanal workings around the mine, so if we do find additional, that could give us satellite feed, which may get us above 80. So quite an attractive opportunity there. I mentioned the dividend yield, it's 3%. The dividend is 8 times covered by operating cash flow. So if you consider $25 million of free cash once we commission the project, currently the dividend costs us $3 million. We could afford to grow that dividend very, very substantially without really breaking sweat and still build a war chest to go after those opportunities I saw in Zim. So that's about time. We are here for the rest of the few days and for the rest of the week in New York. Thank you for your attention.